When it comes to trading, understanding Forex chart patterns can be the difference between being a gambler and putting the odds in one's favor. Developing the skill to recognize the major patterns in real time can give you a trading edge or improve your profitability as an extra tool in your trading toolbox. I will explain in this video how to read Forex chart patterns and candle formations and the best way to identify opportunities within any single time frame. I will begin by answering some basic questions about what Forex chart patterns are, although these patterns can occur in all speculative markets and not just in Forex. What are Forex chart patterns? Forex chart patterns are structures of price movements that tend to replicate themselves in different periods and time frames. They respond to specific conditions that produce similar results. In that line, traders follow those patterns to identify trading opportunities. Forex chart patterns are based on technical analysis, and they represent price actions and specific pair behaviors previously classified by historical movements and context. They help traders identify market sentiment, mode, direction, and entry and exit points for trades. Types of Forex chart pattern. The number of patterns that can potentially be identified within a single price chart is vast. It can even grow every day as new assets, pair behaviors, and financial instruments are continuously created. In other words, as the market evolves with the passage of time, so do chart patterns. However, there are three popular types of Forex chart patterns that traders pay most attention to, and it is therefore a good idea to focus on these. 1. Continuation chart patterns indicates price likely to continue moving in same direction. 2. Neutral chart patterns indicates price likely to continue to range. 3. Reversal chart patterns indicates price likely to change direction. Of course, there is no tool that can tell you with 100% certainty what is going to happen in any market. As traders, we try to identify hints that, when aligned, show us potential market directions. When clear Forex trading patterns arise, they are accurate more often than not, but they can also fail. So, trade responsibly and use risk management tools. Let us explore these types of Forex chart patterns. Continuation chart patterns. As its name suggests, continuation chart patterns are price formations that signal the dominant trend should continue if the pattern requirements are fulfilled. Continuation formations usually happen when the pair consolidates recent runs. They can offer good opportunities because the trend is your friend. When these chart patterns occur, they suggest that investors are taking a breath before resuming the ongoing trend. Trends rarely express themselves in direct straight lines, instead tend to make lots of retracements and zigzags. The most popular Forex continuation chart patterns are flags, rectangles, pennants, and directional wedges. Reversal chart pattern. Forex reversal chart patterns are formation which suggest winds of change have arrived on a price chart. These chart patterns indicate that the dominant trend is coming to an end. Among popular reversal patterns are head and shoulders, double tops, double bottoms, triple tops and bottoms, and directional wedges. Neutral chart patterns. Also known as bilateral chart patterns, these price formations happen in both trending and ranging markets. The key element here is that these Forex chart patterns can move the price in either direction after a trigger occurs. Popular neutral chart patterns include both symmetrical and asymmetrical triangles. Top chart patterns every trader should know now. We can talk in detail about the most popular patterns commonly seen in Forex charts. Head and shoulders. Head and shoulder formations are reversal chart patterns. Please like and subscribe to help us grow as a channel and share more videos. These can be found as the top of an uptrend or as the bottom of a downtrend, with the latter known as an inverted head and shoulders. It signals a change in trend direction from bullish to bearish or vice versa depending upon whether it is occurring in an uptrend or in a downtrend. When it acts as a topping pattern, the price structure shows three peaks. The first and the third peak are similar in height, while the second is the highest. It signals a bullish to a bearish trend change. In traders' words, the first and the third peaks are known as the shoulders, and the second is the head. Then, the neckline is the bottom after the first and second peaks. The signal comes when the price action breaks below the neckline after the third peak. Some traders state that the neckline should be strictly horizontal, but others prefer to also consider necklines that are not equal. In that case, if the neckline slopes down, it signals bearishness. In the other case, if it goes up, it signals bullishness. When trading this popular chart pattern, the entry point is located after the break of the neckline following the third peak. Stop loss can be placed either above the second shoulder or above the head. The profit-taking target level will be determined by measuring the height of the pattern between the neckline and the head, and then adding that number of pips from the opening price. In simple terms, the profit target will be the same height as the pattern. On the other hand, please pay attention to the wider location of this or any other Forex chart pattern, as it could face strong resistance or support. Obviously, if a pattern had developed and you are getting 75% of the profit target just ahead of a strong resistance, take your money and secure your profit. Spartan Trading Academy. For several months we have worked consistently to create it, and it's finally available for you. This academy will include more than 30 videos that will cover market structure, price action, chart patterns, advanced supply and demand, and much more. Check the link on the description of this video to join. Double top. The double top chart pattern signals a reversal as it takes two rejections of a similar resistance area and suggests price exhaustion. It describes a price movement that makes two peaks following strong trending moves. The signal comes when the price fails to break above a level twice and falls below the valley's bottom between the two peaks, also called the neckline. The position is opened after the price breaks below the neckline as a rejection of the second peak. Then, the profit target is set by the distance between the tops and the neckline. Obviously, you can revise your position once it is completed and let it go for further gains. You can also close before a critical level if it has gone close enough to the profit target. Remember, reading Forex chart patterns is not an exact science. If you are a conservative trader, you can wait for a second confirmation in the form of a retest of the neckline from the other side, which should hopefully then act as a resistance level. Double bottom. The double bottom chart pattern is a formation that combines two bottoms and a peak between them. It signals a reversal from a bearish trend that turns into an uptrend. When the price is falling, it fails to break below a price level twice, and it breaks above the level of the first retracement following the second bottom. The position is open when the price breaks above the neckline after the rejection of the second bottom. Then, the profit target is set by the number of pips between the bottoms and the neckline. As always, you can revise your position once the trading plan is completed. You can also close the position before the target price is reached if you see strong resistance ahead. For a more conservative approach, wait for the rising pair to get back to retest the neckline, which should have become support. Recommended broker is Longhorn FX. It's an ECN broker dedicated to delivering a superior trading experience to traders. 2B breakout. A 2B breakout is really just a double top or bottom, but one where the second top or bottom quickly exceeds the high or low of the first top or bottom before reversing very quickly and strongly. It is a failed breakout, and the faster and more dramatic its failure, the better. Now, of course, technically, every double top or bottom is a 2B breakout if the second top or bottom exceeds the first one by any measure at all. However, we can usually distinguish true 2B breakouts by the fact that there is a candlestick wick making the breakout, followed immediately by a strong candle in the opposite direction.